Hey guys, this is Justin. Welcome to the Excess Returns Investing channel, where we focus on the strategies and tactics that can help you become a better long-term investor. If you're interested in learning about investing, please join us as we learn along with you. Thanks for checking us out. In this episode, Jack and I talk technical analysis with Fairlead Strategies founder Katie Stockton. As fundamental investors, this was a great learning experience for us as we covered a wide range of ways in which technical analysis can help all of us in our investment strategies. The three biggest lessons you'll learn in this episode are: 1, the major tools available to technical analysts and how Katie thinks about deploying them. 2, how Katie uses technical analysis to build a sector rotation portfolio that also manages risk. And 3, how fundamental investors can use technical analysis to improve their investment strategies. As always, thank you for listening. Please enjoy this discussion with Fairlead's Katie Stockton. Just one more thing before we start. For anyone who is new to our channel, I want to thank you for coming and invite you to join the Excess Returns community. Our goal is to build a community of people who want to work together to become better long-term investors. And thanks for the support of our viewers. We have more than doubled our subscribers on YouTube in each of the past 2 years. We want to do it again this year, so if you find our content valuable, we hope you will join us and subscribe to our channel and like this video to help us continue to grow this community and reach our goal. We appreciate your support. This episode is brought to you by Alpha Architect for Advisors. Whether you're an established firm or just starting out, you know the right systems can be the difference maker to achieving your growth goals. That's why Alpha Architect now offers a suite of turnkey model portfolios that can be customized to fit your practice. Built on Alpha Architect's decades of rigorous academic research, our model portfolios aim to systematize portfolio management so that you can spend less time tinkering with funds and more time finding your next great client. Systemize today to save time tomorrow. That's building with conviction. That's Alpha Architect for Advisors. To learn more about Alpha Architect's model portfolios and to schedule a consultation, visit advisors.alphaarchitect.com/models. That's advisors, ADVISORS.alphaarchitect.com/models. Alpha Architect for Advisors, built with conviction. Hi, Katie. Thank you very much for joining us today.
Of course. Good to be with you guys.
We are going to talk all technical analysis with you today. I think you've probably seen. You've been doing this for a number of years. Your entire, I think, investment career has been in technical analysis, which that's going to allow us to kind of get at asking you what works and maybe what doesn't work with technicals. The other thing that's going to be cool to talk to you about is how you've taken your expertise with technicals and actually put it within an ETF wrapper. So retail investors and professionals can sort of access your strategies in a tax efficient way. And then the last thing I'll say before we get into it is, in doing some research for this, I think it's very cool and it sort of showcases the success of your firm that both Fairlead Strategies was named the finalist for the best independent research house from technical analysis in 2019, 2020, 2021, and you yourself were a finalist in 2021 for the technical analyst of the year. So congrats to you.
Thanks so much. Yeah, that was an honor.
One of the questions I wanted to ask you is, early in your career, you were at a few different decent sized research firms doing technical analysis, but a few years ago, you decided to go out on your own. So I just wanted to start there with your path and why you decided to start your own firm.
Yeah, I mean, listen, it was a bit of a leap for me, having been on Wall Street most of my career. But in 2018, there was a little bit of a change in the regulatory landscape, I feel like, for sell-side research. And it wasn't really impacting me directly, but it was something that I felt was changing the nature of how people were paying for research. And that to me, it wasn't a great trend, quite frankly. And my research being technical analysis and also somewhat top-down oriented when I was on the sell side, it did not lend itself very well to investment banking research, right? There was, we weren't taking sort of deep looks into individual companies. So in that way, we wouldn't be able to sort of foster that investment banking relationships and what have you. So, we felt like might make sense to go out on our own with that in mind and also try to reach a bigger audience, because we historically had really focused on institutional clients, but we were able to bring our research to a broader audience. So from Wall Street to now, including Main Street, having sense that there was an appetite for it. With social media and technology, more and more people were getting exposed to technical analysis, and we felt like there was a real sort of applicable it was a discipline that anybody can really apply, right? It's not something that takes credentials to understand, although credentials certainly help if you're going to be a professional in it. But it was something that we felt would help people in their personal investing, not just professional investing. And we wanted to bring that kind of institutional quality research to a broader audience. And we could do that as an independent research provider. And we could do it under a subscription model, which kind of removed itself from some of those compliance issues that came to light, around 2017, 18.
Yeah, very nice. I think you've done a good job of building your personal brand and sort of standing out. And so when you can do that, you have kind of an edge in terms of trying to get people's attention and then telling them what you do. And then that leads to, hopefully them subscribing or them becoming an investor or what have you.
Yeah, we've been doing this for a really long time. And so, and because we've had always really the ability to have an opinion on anything that has a price, I think what we do lends itself really well to sort of media and some coverage because, I can have an opinion on Bitcoin without knowing very much about the fundamentals of Bitcoin. And that opinion doesn't take me very long to develop it. And that's why I guess what I mean in a way that it's accessible. Accessible to really anyone who takes a little time to understand the different sort of facets of technical analysis and price-based analysis. It's so invaluable in terms of understanding, I think, any kind of risk-reward profile for a security. So I really believe that everyone should have it on their radar, and if they can apply it in a way that's a bit more systematic, that can be a real benefit to their sort of, the upside in their portfolios and also especially for risk management.
Can you talk about that risk management piece a little bit? I know that's something that you emphasize and pay a lot of attention to. It's not just, the buy part of it. It's the managing risk as well.
Yeah, I'd say we probably place the most importance on that. In fact, I think technical analysis is known for market timing in a way. We're always trying to time our entries and exits. We want to buy something that's near support in a favorable trend. We want to sell something that's near resistance or losing momentum or that has some kind of breakdown. So we have these triggers in a way from the charts that can help us understand if it's a favorable entry or exit. So that's, I think, what it's primarily known for. But to us, the risk management piece is just really essential because that's where you can avoid these big drawdowns that just act like such a drag on long-term performance. And you can do so in a systematic way. So it takes out some of the emotions. I think that probably resonates with you guys in terms of your mathematical approach. Takes out, that kind of guesswork. It is, something with some of our indicators would be either on a buy signal or a sell signal. There's no in between. So it's in our interpretation as human beings, that's the subjectivity, but the indicators themselves, I see them as very objective and giving us a very clear takeaway. How we use it, of course, then is another thing, but it's a great sort of tool to have to say, okay, well, this trend has been going for years. We now have a sell signal in one of our momentum gauges. And then we have this information, right? And we can choose whether or not to act on it. But at least we have the information to say, well, now we know that we might be fighting a new trend. And with that in mind, we can either, hedge our exposure. We can establish a tighter stop loss level. We can reduce exposure in relative terms. There's a lot of ways that we can infer, from that information, ways to manage risk.
I want to start with a high-level question. We've had a few different people who practice technical analysis on the podcast, and they all answer this a little bit differently, so I always like to ask it. How would you define technical analysis and what it is?
It's a study of price trends, and in doing so, you're understanding the supply and demand for any given security. And it's in that supply demand that you're also getting a read on essentially market psychology. So it's almost like the manifestation of market psychology in supply and demand, which of course is driving those prices. We believe that any given bit of information boils down into a decision, right? That decision is buy, sell, or hold. And not to oversimplify it, but the price does reflect that, and it's reflecting all the known information at that time. So to have a sense of the primary trend with all the information out there sort of boiled down into that one decision, I think is a great way to make sure that you have more probabilities in your favor. And that's ultimately what we're trying to do. So we're not trying to be super predictive in our work. You'll never hear me saying at year end, here's where I think the S&P 500 is going to end, because no one knows that answer, of course. If we did, we'd probably not be even having this conversation. I'd be on my yacht somewhere. But, in reality, it's just trying to stay on the right side of the trends over whatever time frame you care most about. And so we're trying to identify those prevailing trends, and also trying to identify when those trends are coming to an end, because we're at a point now, I think, with all the tools available to us, that almost anyone can go online and say, well, I've got these great free charts at my disposal, and I look at some moving averages, maybe something a little bit more sort of esoteric than that, but you can get a good read on trend from that. And then if you can then pile indicators that will help us understand if that trend might be maturing based on market history, that's a great takeaway from the charts. And that, to me, is one of the primary goals of technical research.
So I guess we won't look out for your annual S&P 500 forecast next year coming.
That can only get me into trouble, I think.
I want to ask you about why technical analysis works. So as like quant investors, we get wrapped up a lot in like trying to find the explanations for why each factor works. We try to explain either it's investor behavior, or it's because the factor is risky or something like that.
Yeah.
Like why do you think technical analysis works? How would you explain it in simple terms?
I think it's just that all the bits of information out there are boiled into that supply and demand. So if you think about it as seeing something as a security as opposed to an entity, so it's not necessarily looking at Boeing the company, right? It's looking at Boeing the stock, or BA. So I almost think in tickers, right? Not in company names, being somewhat U.S. equity centric. So I think it's knowing that there is more than just the company's fundamentals driving that stock price. There is that market psychology, and that market psychology can be influenced by top-down factors, and it usually is, quite frankly, especially in a tape that's not a very strong bull market. You have interest rates influencing decision making. You have crude oil prices. You have Fed actions, you have, you name it. There's so many different influences. And I think it's a great way to try to understand, how those influences are boiling down into that decision. So, but we don't have to really explain it. The charts won't really answer why something is happening. You can speculate, but they will tell you what is happening. So it's not why, it's what. And you can kind of choose to take it or leave it. But I often say, and it's sort of cynical, but once we figure out why something's happening, it's probably going to change anyway. So we can just adapt and let the trend guide us.
Yeah, we use some momentum models for stock selection. We found the same thing with clients. Like a lot of times clients want to know why. Well, why is the momentum model buying the stock? And the answer is it doesn't matter. It doesn't care. Like all it cares is what's going on with price. That can be difficult to explain, but it certainly works over time.
Yeah, and you often see rotation in the relative strength of a security sometimes before you see a price breakout. And that can be really cool. You can see this accumulation, and it's often well before any kind of great news hits the tape. And you even sometimes see price action where you do see some, pickup in volume, something's going on. And then sure enough, the next day you get some news, right? So the price does hold real value in that sense, in that it can be telling even when you feel like there's a lack of data to work with fundamentally or on the macro front. The mantra, or I don't know, the mission statement of the CMT Association, which is our Chartered Market Technician Association, is to navigate the gap. And that's what they're referring to, is that when, let's say quarter to quarter, you're waiting for that quarterly earnings data. In between, there's a lot of price action that's influenced by something else. So it's almost that short to intermediate term period where the charts can really add value with the assumption that the longer term trends will be driven by what they should be driven by, which is those fundamentals.
How much do you think what are the biggest changes you've seen in technical analysis throughout your career? Like, I would assume technology is part of this. I believe it's is it Helene Meisler who's still on Twitter, drawing charts on paper, but I would assume most people aren't doing that these days. But what do you think are the biggest, changes you've seen in terms of how it's practiced?
Yeah, it just far more widespread. I just think about the media coverage of technical analysis. They don't really talk about it in the way that it sounds like they're saying, well, this is my technical analysis, but they're often referring to breadth and sentiment and leadership and relative performance. All of that falls into, sort of our world. So much more widespread, and I attribute that to technology, just the access to information out there and to data, the market data that we can all access and often free. And now we can access these technical indicators that used to be, third-party providers to various software, which was extremely expensive. So it's just that access to information and data, and I think that's why it's become much more widespread and widely accepted, in addition to the fact that it's helping people manage risk and find opportunities, right? So that's what I've really noticed is just the uptake, just the increased uptake. And also, with that, folks have gotten very sophisticated in their investing in terms of incorporating derivative strategies and ETF portfolios and things of that nature, and technical analysis. When you're spread somewhat thinly and trying to understand various markets or various securities or various sort of approaches, to have one singular sort of methodology on the technical front to approach all of those different sleeves, I think is a real value add. So certainly just that accessibility. In terms of indicators, I think there's a little less focus on volume. That's something that I walked away from a long time ago, because there are so many influences on volume these days, and you guys probably know this very well. It's it's not as pure maybe as it used to be. Like those orders might be driven by just passive ETFs or something of that nature. So I don't know that you can trust the volumes as much as you could previously. So that would be one thing I would say on the indicator front.
Do you think that technology, I would think, would make the job harder but easier at the same time? Like, it would make it easier because you have, a lot of things that you would have to be done by hand before it can be done with technology. It would be harder, I would think, in terms of there's probably a lot more out there, and it's probably harder to parse through everything there is and figure out what's meaningful. I mean, do you think that's a fair way to look at it?
Yeah, I mean, for sure. And this is why I always say if you can approach it systematically, and that doesn't mean you have like a trading system per se or a model. It doesn't have to be, any big task, but rather to kind of come back to the same tools over and over again, the same charts over and over again, or the same analysts over and over again, because that way you're going to have sort of a consistent way of watching the markets that you care most about. I tell people one of the best ways to get started in technical analysis is to take a little, real estate on their screen and build a chart template and use that chart template over and over again. Every indicator, whatever suits you, really. It's not that important which indicators you use. It's more important that they suit your way of thinking or visual thinking. So if you come back to those same tools time and time again, I think that's where you can get the real takeaways, because we know there's no holy grail in indicators. We know that they're not always going to be right all the time. You'll get whipsawed often if you just use one. But if you have a good combination of indicators that you find value in, I think you'll start to understand the nuances of them and the environments in which they work best, and the environments that, where they sometimes fail you. So just to have that consistency, I think, is where the value add is. And not everybody's doing that. I think that's probably one of the bigger mistakes, is that people are consuming too much, right? They're going onto Twitter and seeing, 8 different technical analysts with different opinions on different securities, and it becomes a bit overwhelming, I think. Whereas it shouldn't be that. It should be more of a methodology, whatever that looks like for that person.
I'm not going to ask you to make a market forecast when you just told us you don't do that, but I did think it would be interesting to kind of look at the current market from the perspective of like the types of tools you would be using to analyze it. Like, one of the things I've noticed, and this may not be true of you at all, but like a lot of the guys I follow that are sort of technical analysts on Twitter have been pretty bullish through this run in the market, and the macro guys have been decidedly negative. So there's been like this push and pull between the two of them. And I'm just wondering, like, if you could talk a little bit about how you would analyze the current market, like what framework you would use.
Yeah, and I mean, by all means, we have to give some level of forecast, right? But they're usually a bit more near term in terms of where there is support and resistance levels that we can key off of for either upside or downside objectives, perhaps, and also what's the current status of momentum. So we do spend a lot of time on that directional bias. And I've noticed the same. I agree that more technicians have been bullish and more macro strategists have been bearish. And it's then becomes the investor's job to marry that, right? To take both the macro sort of perspective, combine it with the technical perspective, and ideally also to have a political input and a fundamental input there too. So that's where you're going to get the most powerful takeaways, when you have sort of different perspectives that all add up to one takeaway. Of course, it doesn't often happen that way. So we'll take, just maybe 2 or 3 out of 4, right? And let that give us a little bit more confidence in our views. For technicians, and listen, we can disagree too, but the momentum has been to the upside for much of this year for the major indices. But there's a caveat in that the breadth has not been good. So the market's been really very narrow, is what we call it, meaning that the participation hasn't really been there. So that's why I think you're seeing some dispersion in terms of technical takeaways, because even though the major indices that are focused on the large caps have done quite well, you're not really seeing the same from other sort of indices. So the equal weighted, the small and mid cap indices, and certainly in the bottom up work, not everything looks like NVIDIA. So there's been a real sort of dispersion, I think, year to date. So we're just past the first quarter between technical takeaways, not just technical and macro takeaways as well. Our take right now is that the bear market cycle still technically has a hold, and I say technically because one of our indicators is our sort of primary trend following gauge, and that trend following gauge still has a resistance level intact. So that tells us we're not out of the woods yet. We also have a comparison in our longer term indicators that holds against early 2002. And if you remember that time frame like I did, we still had another 7 months or so to go before we got the final low to that bear market cycle. So it's not to say we're in store for that again. I actually think we probably are not, just based on what's happening in treasury yields and otherwise. But we just don't have enough evidence to say that we're coming out of it yet. And by that, I mean, looking at those long-term indicators, we want to see them improve further. We want to see them diverge from what they look like in 2002. We want to see that trend following model that I mentioned as it pertains to the S&P 500 reverse. That could happen very quickly if we're not far from that resistance level, which is, for me, 41.55. We're trading around 4100. And then also I want to see at the same time, and this is something that usually would go hand in hand with some kind of breakout, would be breadth improvement. So breadth improvement that's certainly more notable than what we've seen up to this point, where we have measures like the cumulative advanced decline line, clear resistance of its own, and at the same time have an influence on market sentiment that's notable, because we, in my opinion, have been in this high volatility cycle since early, or well, really even late to 2021. And the volatility index, which we use to measure sort of transactional sentiment, is still in this high volatility regime based on support being intact there. So we'd also like to see that the VIX break down below that support to suggest that sentiment has now kind of shifted, that it's not necessarily complacent, but sort of moving into a new normal where people are actually very willing to put their cash to work, and that this is more than just another sort of bear market relief rally.
Yeah, one of the cool things about technical analysis to me is this idea of like not getting married to your view. Going back to the macro guys, you get a lot of these guys that just will not change their opinion no matter what. And you've kind of highlighted the types of things you're looking for to change your view. And that's a cool thing about price, I think, is it allows you to change your view and to pivot when other people might get stuck, in what they believed in the past.
Yeah, I mean, it's really dynamic, and so we're measuring things. So sometimes listen, we are at risk of getting married to our views. We're human too. So, because it is in all how you're combining these indicators, right? But, at the end of the day, I think technicians get a good reputation in bear market cycles because they don't get married to the market in the same way that perhaps a fundamental sort of research strategist would. because, you see a breakdown and you have to honor that breakdown as increasing downside risk. So I think that did happen in 2008, where technical analysis, the reputation improved in that bear market cycle when there were some sort of headliners that became well known for having sort of avoided much of that downdraft. So I do think I call it the inverse property of technical analysis. Like when the market goes down, demand for technical analysis goes up. And in a way, it's because people can't explain the price action based on what they're seeing from that macro or fundamental perspective. But it is truly dynamic. And I think that's kind of the beauty of it, and the fact that, again, it takes out some of the emotions that get you attached to things.
One of the things you'll see in the popular media a lot is these popular technical indicators, whereas the 200-day average or the death cross when the 50 crosses the 200 or something like that. Like, how do you think people who are not technical analysts who are seeing that type of stuff, how do you think they should think about those things?
Well, it depends on which things, we're talking about, like the Hindenburg Omen or the death cross. These are sensationalized setups is the way I would put it. And they're often not as timely as you would expect based on the publicity that they're getting. So it does kind of depend on what we're talking about. The price patterns even have somewhat silly names at times, a double bottom, I don't know. But what they're trying to reflect is just a visual representation of support and resistance. So I appreciate the price patterns, even though I think sometimes they sound a little bit silly. But the perception of these setups and patterns just needs to be substantiated, right? If somebody's going to, believe in something, well, then I think just doing homework, right, to believe in some kind of cycle or some kind of seasonal influence, and also to kind of keep it real in that, cycles, seasonal influences, they can change or they can break up, briefly and then sort of regroup. And you see that with correlations too. So, traditional asset allocation would have suggested that Treasury should have done much better last year, and they certainly didn't. So when those things break up, a lot of people are left saying, well, this is impossible. Like, how did this happen? I think we just need to trust that the market can throw anything at us. And that's why we have to have all of these sort of indicators informing us, because they're going to tell us when something is out of line with market history or expectations. So, we like to hear all of that, stuff. We think it's kind of interesting, but it's pretty rare that we'd ever act on it unless it's aligned with our methodology, which is pretty systematic.
Yeah, it's funny. It's like for the average investor, when these things have a cool name, they're almost more likely to want to believe them. Like you referenced the Hindenburg Omen, but like recently, even me, like I was on Twitter and there was something about like the Zweig breadth thrust or something, and I'm like, oh no, we're obviously in a huge bull market here because the Zweig breadth thrust is happening. I don't even know what it is, but like the cool names definitely gets people into it.
I know, and there's usually reasons why people are talking about those things, because they're seeing extremes in the market internal measures, and we like to certainly have an awareness of the market internals, but we always will let price action drive our decision making before anything that we see in those breadth or sentiment data. And that's important. So we start with price, we'll look at some relatives, and then we go to those market internals. And that's usually where they're coming from. I saw one recently that said, well, the market is almost always higher at year end if it doesn't breach the December low in the first quarter or something of that nature. And, maybe back testing that, certainly gives some good results. But there's no sort of causal relationship there. So, if you're, investing based off of that and that alone, I think it can be really risky. I think you have to, again, just respect the price action. And if something does break down, irrespective of what that one sort of takeaway would the message it would send, I think you have to just, sort of be mindful of that.
And the other thing with that is, we see this in our world too, is you have to always ask yourself, what is the end? What is the number of observations? Because a lot of the times they'll be like, 3 times in history does this happen and the market always went up 3 times. Well, there's only 3 observations. So how much confidence can you put in that?
Yeah, and you actually kind of raise a point there in terms of bear market cycles. I haven't lived through that many of them, nor have any of us. I mean, we really don't have a great sample size of bear market cycles. And that makes them harder to navigate, right? We have market history for really just 3 of them since I got started in the late 90s. And so in a way, we can see that this cycle has, it's great as a learning experience. It's sort of painful in some other ways, and volatility can be damaging and certainly harrowing. But it's good to have a different kind of environment to learn from and to watch how these indicators sort of act in this environment. I remember in 2008, having really only lived through a couple of bear market cycles at that point, some of the indicators that I had started to depend upon, which including something like the put-call ratios. I mean, you as quants know, just some things got so blown out. It was like the extreme got far, far more extreme. And, that was a great lesson. In hindsight, what it taught us is that we needed to diversify the market internals that we had on our radar. So now in our morning research, we have a whole host of market internals that we're looking at collectively, as opposed to maybe 2 or 3. And we're taking that host of indicators and we're highlighting when they're at extremes, overbought or oversold. And it's when we see a collection of them at an overbought extreme or oversold extreme that will actually give that some attention. So, you can kind of adapt to these market environments, but we are challenged by the fact that we don't have that many bear market cycles to use for reference. And this is why, it's a pretty difficult market to navigate.
Are there certain asset classes where technical analysis works better than others? I mean, does it work across all asset classes, or are there certain ones where it's, it works a lot better?
I think that anything that has like a good sort of deep global, very liquid market is going to lend itself best to technical analysis. And the first thing I go to are commodities, commodities and FX being sort of deep liquid and global markets. And also arguably with somewhat of a pure supply demand influence. Whereas there's not as much headline risk, right, for something like corn prices as there would be for the company Mosaic. So I think commodities, FX, certainly it really lends itself very well to that sort of area of global markets. And I actually think a lot of the tools that we use and the technicians that sort of brought the discipline to the masses, they've really got their start in futures trading often. So it's not accidental. I mean, one of the models that I use, it's called Ichimoku, and it was developed in Japan around the rice trade. And it's become something that I find really very valuable. So what that leaves us with is, well, how does it work for equities? And again, I would say it's the same way there. It's like the more liquid something is, in a way, the cleaner the chart will be, and the more mindful perhaps that the levels, the price would be at various levels. So I think it's just more liquidity is better. We have such a liquid market anyway in the U.S. primarily that we're watching. So we don't find that many issues in terms of like very gappy charts or anything that would influence the charts in a negative way. But really it's commodities and FX.
Just one more I want to ask you before I hand it back to Justin. I want to ask you about the ideas of support and resistance, which you referenced earlier. Like for me, as someone who's not a technical analyst, when I see the idea of support, I'm thinking, if we're headed into support, we're likely to bounce. But if we don't bounce, like look out below or something like that. But I mean, is that the right way to look at those types of things? How should people who are not technical analysts look at resistance
so like
and support?
If we think about support as a primary area of buying pressure and vice versa for resistance, you should assume that a support level will hold. And you do that because you're assuming that the primary trend, whether it's up or sideways perhaps, is going to persist. And that's almost always the right way to approach something, is that you assume the prevailing trend will remain intact. Now, to know where there's support or was support in the past, and to see that level broken, well, that means something's changing, right? So you would want to react to a breakdown below support. But the assumption should be that the support level will hold. But then, of course, we're also reconciling the identification of those levels, the key levels, support and resistance, with our indicators. So we'll know perhaps if something was in this great, sort of sustained uptrend, and it had support at its rising 200-day moving average, just to keep it simple, and it was coming into that 200-day moving average with very weak momentum, well, then we'd know, that it has a better chance of breaking. So as much as you should assume that the long-term uptrend is intact still, you can kind of, set the tone by having the indicators inform whether that uptrend has lost some momentum. And that there's such value in those indicators. I like to group them three ways. I call them either trend following, overbought, oversold, or relative strength. And we have a couple tools for each of those that we use a whole lot. And taken together, they can help you understand if perhaps that level is more vulnerable.
So let's step into the ETF a little bit and the investment process that you're using to manage the fund. And by the way, I did see that the ETF hit its 1-year anniversary, which is great. And it's also great to have, we like having smaller issuers, smaller issuers on, because, the ETF space is like dominated by a few players. So when we see more entrepreneurial firms having success, and I would say your fund is a success given the assets it has in it, that's, something we like to sort of highlight and talk to people about. But I wanted to, and I'm going to let you describe the strategy, but as I understand it, it's like a sector rotation when it's risk on, sector rotation strategy, selecting various ETFs. And then there's a risk off, bucket as well. So can you just kind of walk us through the investment process here?
Yeah, of course. And thanks for saying so. I think the first and foremost thing to think about when you're thinking of our ETF, which is called the Fairlead Tactical Sector ETF, or TAC, TACK, is that it is driven by a technical model, and the methodology is long-term in nature. So what we're trying to capture are long-term trends with momentum, basically, and also relative strength. And we're first applying that to the sectors of the S&P 500. So we start with the sector spider ETFs, and we are evaluating those based on our model for characteristics that suggest that they're in long-term uptrends that still exhibit some momentum. And those are the sectors that we want to have exposure to. And then we'll rank those sectors by sort of their relative performance. And, that's when we have a strong market and we have a lot of sectors to choose from. So we essentially have 8 buckets that we are trying to fill. They're equal weight buckets of about 12.5%. And ideally, in a very strong tape, we'd fill all 8 buckets with the 8 strongest sectors based on our model. But as you referenced, there are times at which we'll move to more risk-off categories or asset classes. And we do that because the market isn't always trending higher. And we don't just want relative performance, we want absolute performance. So we want to protect ourselves on the downside and avoid those really, really big downdrafts and not just look for relative performance during those. So what we found is that moving into a combination of alternative asset classes to equities was the best way to do that. So we'll take the buckets that were sort of in these various sector ETFs and move them not exactly a third, but into somewhat close parts of gold via GLD and short-term treasuries and long-term treasuries. So it's those 3 funds that then become our sort of risk-off positioning, and it's a very dynamic model, so it's going to react to shifts in long-term momentum. And the goal is to participate, but also even outperform by leveraging the sector sort of rotation in the market and being there for those uptrends. But then, of course, and when the market isn't in a solid uptrend, to have the ability to move either more defensive on the sector front or defensive and into, more of these risk-off categories, which historically have, especially when they're diversified, outperformed the equity market during downdrafts. So we built the model over the course, of our sort of building Fairlead Strategies. And we found that we had something that was a very conservative way to manage risk, and that's very suitable to sort of our process as well. So that we're trying to come up with sort of a holistic way to almost replace the old buy and hold.
And by the way, I like the ticker symbol because it's
Thank
always
you.
nice when you have a catchy ticker to get people's attention.
Yeah, it helps. Memorable.
So is this a strategy that was were you able to test this strategy sort of backwards? And I'm just curious as to, it's always, I know we got to be careful from a compliance perspective about risk and return profile type stuff, but I'm just wondering where it would sit in someone's portfolio and what they might expect from a risk volatility perspective.
Yeah, I mean, by all means, we have a back-tested model going back to early 2000, and we wouldn't have launched the ETF unless we had confidence in the model. And I would say in terms of fitting into a portfolio, we found people are using it in different ways. So if it's an individual investor, theoretically, TAC could just replace a portfolio, right? You could, put your whole IRA in TAC and forget about it. And I think feel pretty good about that because it is dynamic. It's working for you, and that's the active piece of it. And it's doing so in the tax wrapper for a non-IRA account. So there's some appeal to that, of course. We felt that investment advisors would be very interested in this product because they're often our research client as well. And we found that they were trying to employ sector rotation strategies themselves, and yet they have day jobs. They're pulled in a million directions. So to have sort of a way to do this, to do it systematically and with the tax wrapper, became very appealing to them. So we're finding that the advisors are sort of either using it as almost a separate sleeve, like a technically managed sleeve of their overall sort of portfolios, or they're usually bucketing it within a U.S. large cap equity sort of core exposure, even though it does have that sort of tilt right now to fixed income. So everybody's applying it differently, but our goal is to create something that you don't have to worry about in terms of the drawdowns. So that was a big piece of it, where we didn't want to participate in the 2008s to the degree with which the S&P 500 did. And I think we've seen the relative performance, the comparative returns really prove the model since inception, which was in March 22.
One of the things that caught my eye when I was researching the fund was you do sort of reserve the right to have a discretionary overlay for market anomalies. So I just wanted to ask, I was kind of thinking, well, maybe during the COVID crash, you could have maybe that discretionary overlay may have come in as a manager or as an advisor on the fund. So I don't know, is that a good example, or what would be an example there?
I think it's a great example, and we actually really hope not to use that discretionary overlay, because that would be an environment that would be very unusual, right? But we want to reserve that right just in case we feel that the model won't work the way that we're expecting it to, just given sort of the extenuous factors. So I do hope not to have to use that discretion. So far, it's really followed along expectations. And even during the COVID corrective sort of phase, we probably would not have used that. It was an example that was, of course, extreme, but the model before it became TAC, didn't go fully risk off during that period because it really unfolded so quickly. It was maybe a 3-month type of event. And because we're using long-term indicators that are based on monthly closing data, we moved somewhat risk off, but we didn't move fully risk off. And that was the right thing because it treated it, I don't want to say it treated it as noise, because it was certainly more substantial than that, but it didn't really have the opportunity to go fully risk off. And then it set it at a better place coming out of it. And, the beauty of the model and of really just any kind of systematic approach is that, we don't struggle with the emotions on the back of these cycles. I think one of the problems that advisors had after that COVID corrective low was getting back to the full exposure that they should have had. It took them months and months to feel confident again to get back into the market. So the model will kind of, take out that emotional element.
Yeah, and I think we'll look back on that period in our careers, and it just was, it happened so fast and so quickly. It's almost like, and it was good that, your system didn't react to that, because the whipsawing effect coming out of it was crazy how much things bounced there.
That's right. And it did reduce some of the exposure, and it was interesting because it reduced the more fast moving exposure, but then got right back to it.
One of the things that sort of happens in the quant world, in our world, is, I'm thinking like the value factor. Like as that became more and more popular, it kind of became less effective. There's other reasons that maybe value has underperformed growth over the last 15 years, but that's one of the potential reasons. Is that true at all in technical analysis, where if more and more people are using an indicator it makes it less effective?
Well, I would say sometimes it makes it more effective. We use something called the DeMark indicators just as a case in point. And I think the more eyes on the DeMark indicators, the more likely these signals are to work. Because, people say, well, gosh, and I remember this when I worked at Morgan Stanley. I would go down to the trading desk and, they would be talking about these indicators and they'd be on the phone with their clients expressing these signals that had popped up. So it became almost like wildfire that, everybody knew that there was a sell signal in AT&T or whatever it may be. And that almost became self-fulfilling at times if it was widely publicized enough. So it can work both ways. I'm sort of a skeptic at times because, if you do feel like somebody's talking, or not somebody, but everybody's talking about something, that there may be less value to it. But in a way, the market action should overrule any of that, right? So if there is an uptrend and it's got very strong momentum, well, there's your message, right? Whether it really makes a whole lot of sense or not, based on what's being, talked about or thrown around, it's just about respecting the price action, and not getting too caught up in all the chatter, because at the end of the day, it really kind of can be that, just chatter and somewhat distracting, right, to whatever your process is.
This is going to be a selfish question here, but some of our models that we run are like in this sort of systematic deep value part of the market. So if you were advising us as to how we would use technical analysis to improve that value stock selection strategy, what would you say?
Well, you don't want to be too early. And I think the charts can be really helpful in not only identifying basing phases, but also knowing when it's ready to advance from that basing phase. And that's what we spend some time on for some of our sort of more value-oriented clients. We're helping them find setups that have a basing phase in place, and then we're watching it with them and watching for a breakout or watching for a momentum shift that's meaningful, as not to be too early in getting exposure to that position. Because what happens with these basing phases is that they tend to, you see something kind of bump along the bottom, is what I would say. So the retest of support can be constructive from a long-term perspective, because that's how you're getting the accumulation over time. But they also can be pretty destructive in percentage terms, especially if you're, sort of torturing yourself by being short-term and entries and exits and what have you. So it's almost better to wait for the confirmation that you get from the breakout, meaning that something clears a resistance level decisively, even if you feel like you're buying higher, versus trying to add exposure in the early stages, because then that's committing that capital to something that probably isn't going to work for X number of months or what have you. So we really believe in waiting for the breakout for anything that's like more of a sort of a basing type setup. And then in terms of, fundamental valuation, what's really kind of cool is that you'll see sometimes, if a fundamental analyst will have a price at which this security becomes attractive, right? There's often support there on the chart. So it's a great way to marry the two forms of analysis to say, okay, well, we've actually seen it come down to $60, numerous times, and there's always buyers there. That's a great message from the market, especially to the extent that it might align with something that would be a fundamental sort of price objective. So it can be really helpful to have both of those things line up.
So we like to ask all of our guests a standard closing question, and that is, if you could impart one lesson to your average investor based on your experience in the markets, what would that be?
I think I'd go back to the systematic approach. To have a suite of indicators or tools, they don't have to be technical indicators necessarily, that you come back to and let those inform your biases, and not to get too bogged down with what we consider to be the noise, right? And the noise can look like headlines. It can be a busy Twitter feed. It can be consuming, too much research. I think a lot of us are guilty of that, even me. I think my inbox is quite full in the mornings. But to really narrow in on the tools that suit your process and your way of thinking, and also your investing style. to know what your investing style is. If you're a trader by nature and you really enjoy sort of staying close to the markets and taking advantage of short-term swings, great. Well, then there's certain tools that will be suitable to that, but those aren't going to be the same tools or the same time frame. Of course, that's suitable for someone who much prefer to, sort of be removed from the market and buy something and hold it for 3 to 5 years, that type of thing. So to know your investment style and to have tools that you come back to repeatedly, to implement that. So, and from a technical perspective, I just think it means having a methodology, and it doesn't have to happen overnight. It's not like, I always tell folks that when they first start reading the books, that's a great exercise because there's so much that they're going to get exposure to, but it takes time to sort of whittle that down into a methodology because you can't be an Elliott wave strategist and a point and figure chartist and a sort of a value oriented investor all at the same time necessarily, right? You have to kind of find your place in the investing world.
That's great, Katie. Thank you very much. We really appreciate this. If people want to learn more about you, your research products, and or the ETF, where can they go?
They can go to our website, so fairleadstrategies.com. There's more information about TAC on fairleadfunds.com. We're on Twitter, so it's pretty easy to find us.
Great. Thank you, Katie.
Thank you.
Of course. Nice talking to you guys.
This is Justin again. Thanks so much for tuning into this episode of Excess Returns. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at JJCarbonell. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.
Justin Carbonell and Jack Forehand are principals at Validia Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validia Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validia Capital.